What if I told you the world's most valuable automaker, worth more than Toyota, Volkswagen, and Ford combined, might not be around in 2 years? Not bankrupt necessarily, but transformed beyond recognition. Its trillion-dollar valuation evaporating like gasoline on hot pavement. I'm talking about Tesla. And before you click away thinking this is just another hit piece, hear me out. Because whether you love Elon Musk or can't stand him, whether you drive a Model S or wouldn't be caught dead in one, the signs are all there. Declining sales, vanishing tax credits, a CEO more focused on government efficiency than building cars, and a stock price so divorced from reality that even the guy from The Big Short is betting against it. So buckle up, because today we're asking the question nobody wants to answer. Is Tesla too big to fail or too irrational to survive? What's not to love about a wildly inflated and underperforming company? I mean, who cares about a stratospheric share price, sinking sales, lawsuits, National Highway and Transportation Administration investigations, increasing competition, waning demand for EVs, elimination of EV tax credits, and a CEO that's more polarizing than sweet versus savory grits? How this company hasn't failed already is a mystery. But first, let's define failure. Tesla is a well-capitalized company with low debt. The probability it goes to zero or even has to file some kind of bankruptcy protection is in the low single digits. I would define failure for Tesla as being valued as a traditional car company, which would choke off as much as 80% of the company's value, force them to restructure their business model, or even merge with another manufacturer. Even if the company abandoned its dreams of autonomous taxis, personal robots, and being an AI company, Tesla could still operate as a car company, albeit at a much lower valuation. And the data illustrates a serious level of fragility. Tesla is currently trading at a PE ratio of 230, a market cap of $1.4 trillion on sales of just $98 billion in 2025. Major investors like Cathie Wood, Ron Barron, and Dan Ives continue to talk about Tesla as an AI company, not an automobile manufacturer. By talking their own book, they have billions invested in Tesla. They push this narrative that the stock is currently undervalued. Wood has publicly stated her projected share price for Tesla by 2029 is $2,600. Just to put that in perspective, Tesla's trading around $477 per share as of this recording. And Wood isn't alone. Most Tesla bulls are just as irrational and completely untethered to any operational reality within the company. Ives believed Tesla would have a market cap of $2 to $3 trillion by 2025, and clearly that hasn't happened. In fact, the top 10 investors in Tesla, which includes Elon Musk himself, hold roughly 42% of all Tesla's issued shares. It's no wonder why there are a handful of people willing to trade their credibility to pump the stock. And recent results aren't great. Tesla's total sales in the US in 2025 are estimated by Cox Automotive to come in about 9% lower than 2024, and Tesla's US EV market share has dropped from 62% in 2022 to 55% in 2023 to 49% in 2024, with 2025 full-year results expected to be in the low 40% range. That's objectively moving in the wrong direction. I hope you're enjoying the content, and if you are, please consider subscribing to the channel. Back to the episode. What would it take for Tesla to fail? Well, structurally or mechanically speaking, there are a couple of scenarios. The most likely version, the company fails to remain profitable from a combination of continued sagging demand, the loss of billions in regulatory credits Tesla has been selling, and persistently late product launches. Recognizing that reality, value and speculative traders liquidate their holdings, while the major shareholders probably hold for some period of time to try and ride out any downturn in the value of Tesla. 60% or more of the company is held by non-Tesla sycophants. They won't be able to hold the price up by themselves. If and when the market wants to reprice Tesla as a car company, not a poser AI pioneer, the stock price could look more like other auto manufacturers. Those companies trade at a fraction of Tesla's current PE ratios and generate 5 to 10 times the sales and revenue of Tesla. Combining a compressed valuation and dwindling revenue, the share price sinks precipitously, and the cash generated through the sales of shares collapses with it. Tesla then must take on more debt to fund its product development and general operating costs. The company is forced to create a new business model that can, at a minimum, produce enough revenue to service debt and to secure more debt. If the company fails to reinvent its operations and revenues fall further, securing more debt becomes impossible, and we watch shareholders and executives scramble for the exits. Can this happen? Absolutely. Will it happen? I think it might. There's a lot of supposition in that scenario I laid out, so let me break this down by giving you my detailed bear argument. If nothing else, consider this a palate cleanser from Cathie Wood and Dan Ives, who'd rather everyone pledge their unshakable fealty to the genius and inevitability of Elon Musk. I've already cited declining sales numbers as cause for concern. If that trend continues, that could be enough to cast real doubt on the future of Tesla. But that's far from the only issue plaguing this company. The federal tax credits for EVs expired in September of 2025. It's caused a surge in EV sales of roughly 20% in the summer of 2025 as people rush to qualify for the $7,500 credit. Tesla has offered some lease incentives and a few lower cost trims, but they didn't lower their sales price to offset the loss of those credits. In fact, most model trims went up in price, so the average Tesla got more expensive by at least $7,500. Meanwhile, larger legacy manufacturers continue to introduce new models and take more of the market from Tesla. Thankfully for Elon, the biggest EV gorilla on the block, BYD, isn't even sold in the US. If you aren't familiar, BYD is the Chinese EV manufacturer taking the rest of the world by storm. They have a wide range of vehicles, starting with compact hatchbacks at just $9,700, with a range-topping pickup at $47,000. For context, in Q3 of 2025, Tesla reported automotive revenue of about $21 billion on roughly 497,000 vehicle deliveries, which implies an average sales price of about $43,000 before adjusting for leases, credits, and model mix. While Tesla may be protected from BYD in the US through a combination of regulations, tariffs, and general anti-competitive bullshit, BYD outsold Tesla head-to-head in the two largest European markets, Germany and the UK, in 2025. My doomsday scenario included a mention of the regulatory tax credits Tesla has been selling to other companies, generating billions in pure profit. And while that doesn't represent a huge portion of Tesla's revenue, in many quarters, it was the difference between Tesla making a profit or generating a loss. Reuters reported that without regulatory credit income, Tesla would have posted a loss in the first quarter of 2025. During the third quarter of 2025, Tesla sold about $417 million worth of credits, creating net income of $1.3 billion and an operating margin of just 5.8%, highlighting how dependent Tesla's quarterly profit can be on that free revenue. Unfortunately for Tesla, and based on the current Fed policy changes, most analysts believe Tesla will see their regulatory credit sales revenue shrink to near zero by 2027. Then there are all the recalls. While most of them are centered around over-the-air software updates and user interface issues, Tesla booked a catastrophically poor average of more than 200 recalls per 100 cars produced. Let that sink in for a second. That's 2 recalls for every vehicle produced. Not technical service bulletins, not customer goodwill fixes, recalls. And when they weren't small software issues, they were awful, including power steering that just stopped working, suspension on Model 3s that would yeet themselves off the car, seatbelts that weren't actually secured to the car, front hoods that could fly open at speed, and let's not forget the Cybertruck, whose windshield trim could taco itself in the wind because it was glued on with an adhesive presumably less effective than Elmer's. For the record, I hope no one listening lost a finger to the Cybertruck's flesh-eating frunk, known to close on people's fingers with enough force to do actual harm. Some of the first Cybertrucks sold for well over $100,000, so bruising your bank account wasn't enough. That Lego brick-looking monstrosity wanted to maim you too. Speaking of Cybertrucks, Tesla has a habit of committing routine bait and switches with their products. At the 2019 reveal, Tesla showed Cybertruck pricing starting at just less than $40,000, with higher trims in the $50,000 to $70,000 range. When production pricing was finally released in late 2023, the base truck started at $60,990, and the top Cyberbeast trim at almost $100,000, roughly 50% more than the teaser price. And it's not just a Cybertruck. Elon has a habit of routinely committing pricing rug pulls. He heavily promoted a $35,000 mass market Model 3 starting in 2016 and 2017, but for years, only higher price trims between $49,000 and $60,000 were actually buildable on the website. Tesla finally announced a $35,000 standard range Model 3 in 2019, but it was a heavily stripped model with reduced battery, no autopilot, and a downgraded interior. It was quickly hidden from the website build pages, so buyers had to order a more expensive trim online and then call Tesla to manually convert it. One last note on the Cybertruck. It was recently announced that sales of the model had so drastically underperformed that SpaceX bought more than 1,000 of them just to move them off the Tesla books. That seems ethical. For reasons only known to Elon and maybe his pharmaceutical supplier, he decided to turn, in his own words, dark MAGA. Speaking at Trump rallies and funding voter turnout campaigns, turns out some of those get out the vote efforts were flatly illegal, but that's for another podcast. He followed that up with the launch of the technically non-existent Department of Government Efficiency, or DOGE. Musk crusaded to reduce waste, fraud, and abuse in government spending and promised trillions in savings. A few months later, DOGE claimed on its wall of receipts to have saved the U.S. more than $214 billion. The IRS, on the flip side, estimated the cuts by DOGE just to federal employment would result in a loss of approximately $500 billion in income tax revenue. Musk aligned himself with an administration led by a candidate that received less than half the total popular vote. And then he proceeded to alienate even those pro-Trump voters. Regardless of your political leanings, you have to recognize the absolutely deranged brand strategy of giving the proverbial middle finger to half the market. And in the half of the market he flipped off were some of his most loyal customers, liberals, conservationists, and diehard EV fans. I'm no licensed psychologist, and there's no nice way to put this, but Musk is a pathological liar. He lies knowingly, all the time, and in ways that would get the average business executive fired, fined, or even prosecuted. He lies to manipulate his stock price. He was actually fined for that. He lies about product launches. He lies about features. He lies about sales and projections. He lies about prices. Hell, he even lied about the Cybertruck armor windows and then proceeded to play himself by having someone shatter it on stage live with a metal ball twice during the product reveal. What the actual hell? This is a CEO you think deserves a PE ratio north of 230? To quote Mugatu from Zoolander, I feel like I'm taking crazy pills. Is it just me? Am I the only one who thinks this is nuts? Apparently not. While the Bulls seem to outnumber the Bears, mostly based on how loudly they shout on CNBC and multi-million-dollar PR campaigns, I'm not, in fact, alone. The patron saint of short sellers, made famous by the movie The Big Short, Michael Burry, has been consistently bearish on Tesla, citing Tesla's PE of 290 trailing and 190 forward-looking, compared to single-digit multiples for global automakers. He also cites a compressed operating margin of about 5.8%, with net income down 36 to 37% year over year, despite double-digit revenue growth. The rest of his analysis is too nerdy and technical to repeat, to be honest, but the simplified version is he doesn't buy the argument that Tesla is actually an AI company and deserving of the huge multiple. Declining margins, even though sales revenue was increasing during that same period, is a bad sign. And the amount of ownership dilution happening with annual stock awards given to Musk and others is beyond reasonable. And Burry is just one example. Seeking Alpha recently called Tesla, quote, the big short of 2026. While it's nice to have companions on Bear Island, the bulls are pervasive when it comes to Tesla. Those stalwarts have kept the stock price in the stratosphere, breaking every historic norm of the public market's behavior along the way. I've alluded to most of this already, but there are true believers that think what Tesla will become in the future is worth the share price now. They believe Tesla will actualize Musk's promise of 50 million robo-taxis being put into service, the implementation of full self-driving, where the car doesn't plow its passenger into a bridge abutment at 70 miles per hour, and the underlying technology developed by Tesla is the real treasure chest, not the cars. They don't even want to talk about Tesla as an automobile manufacturer. To bring that up to them just shows what a simpleton you are. There's also what some would refer to as the Elon trade. Simply having the mere opportunity to invest indirectly in Elon is worth the premium. And I could be wrong. I'm certainly taking an aggressive position on the timeline of a potential Tesla collapse. I'm almost guaranteed to be wrong about that, but hey, you clicked on this video because of it, and given my normal YouTube analytics, 95% of people won't make it this far in the episode to see me contradict myself, so no foul, I guess. I could be wrong. The old saying, the market can stay irrational longer than you can stay solvent, is probably true. Tesla is a perennial reminder of this. None of this makes sense. All of it defies how companies have been viewed and valued since the invention of publicly traded stocks. But none of that matters. When you have enough people with billions invested in the success of a company, the likelihood of that company failing is incredibly remote. People who invest big in this company don't just like the stock, they worship it. They sure as hell aren't going to publicly disclose any trepidation about it because they don't want to impair their own investment. Even if deep down they believe this stock is trash, they aren't going to commit ritualistic portfolio suicide by telling you that's what they actually think. Elon is one of the wealthiest human beings on Earth, and with that comes tremendous influence and power, both of which he will wield to promote the ongoing success and growth of Tesla, SpaceX, Starlink, X, Grok, and anything else he has a vested interest in. And he's good at it. A technical, political, and marketing Svengali. The guy is as impressively resilient as he is reckless. It's probably foolish to bet against him. Look, I know the Elon stans will think this is a brutal and unfair assessment. And I want to be clear about something. I genuinely hope I'm wrong. Not because I own Tesla stock, I don't, or worship at the altar of Elon Musk, I don't do that either, but because thousands of jobs and billions in market capital depend on this company. Because the EV revolution matters for our technological future. Because competition drives innovation, we need Tesla pushing the industry forward. But hope isn't a strategy, and enthusiasm isn't analysis. The numbers tell a sobering story, even if the bulls refuse to read it. Whether Tesla fails spectacularly or simply gets repriced as the car company it actually is, one thing is certain. We're watching one of the most fascinating business stories of our generation unfold in real time. That's it for this episode. As always, like, comment, and subscribe. We'll see you next time.